This is the portfolio I shared down below, and it's typically split into two different categories. One being the growth portfolio, which is made up of a bunch of high growth stocks that are investing heavily into the future, and then the other is split into the dividend growth portfolio, which has 19 very defensive, non-cyclical, amazing compounding companies that typically grow their dividends and increase their earnings over time. Now, I mentioned in my most recent update, there's a couple names that I'm typically thinking about cutting out during a time of this economic cycle. One of them right now is Caterpillar. We're going to talk in this video why that is. What is a cyclical stock? What makes this, in my opinion, a bad time to be buying stocks like these? We're going to talk about the economic cycle, how this affects companies like Caterpillar, which stage of the economic cycle I think we're in, and what we're going to be going into. And then we're going to talk about how stock prices are reflected from that, and then give an example for one of the companies that I own and how they should be focusing on a time like this, and then compare the performance for a company like Caterpillar versus some major tech companies. It's going to be a fun one. If you haven't seen me before, my name is Jordan. I'm a millennial investor, and I like to go over all sorts of stocks. Now, currently in my portfolio, in my growth portfolio, this is my current weighting of Salesforce, Amazon, Google, and Crocs, my four growth companies. And if you look at my dividend growth portfolio, this is it right here, which is shared down below in the description. So with the possibility of maybe cutting out Caterpillar, I think it's time you hear me out. If you want to buy this stock, if you want to sell this stock, this is going to give you information you need to know so you can accurately make that decision. So it's going to be a fun one, and let's go ahead and get started by loading up Caterpillar's long-term revenue growth and profitability story. But before we get into all that, we have to talk about today's sponsor, MooMoo. MooMoo is a new up-and-coming brokerage that is taking the world by storm. Commission-free trading, level 2 data, advanced technical indicators, earnings calendars to see the date of financial statement releases, and institutional tracking to follow Warren Buffett's portfolio are just a few examples of what MooMoo has to offer. With this being my first sponsor in the channel, I have fully vetted their company and stand behind their vision. MooMoo currently trades on the NASDAQ under ticker symbol FUTU for FUTU and is SIPC insured. If you sign up today using my special referral link, then you can receive $10 plus an additional 15 free stocks pending certain deposit requirements. Free stock amounts can be as high as $1,000, so sign up now using the link in the description or pinned comment down below. You would help support me and my channel by doing so and give yourself an edge in the world of investing. Thank you so much, MooMoo, for sponsoring this video. Now back to the content. Okay, we're back, and let's go ahead and look at that revenue growth story I was talking about. Now notice here, before I talk about any numbers, something that's a cyclical business typically has ebb and flows. It goes up, it goes down, it goes up, it goes down. This looks like waves on the sea. Big roar up, big roar down, big roar up, big roar down, and so on and so forth. And that's typically what you see from cyclical companies. Now, free cash flow has been the same way, just like revenue. It is free cash flow up, free cash flow down, free cash flow up, free cash flow down. And something that's typically very important for a company like this is timing. And when you look at a cyclical business, what does that actually mean? Well, I have the actual definition here pulled up, so if you want to pause this, if you want to look at that and see what the actual definition of a cyclical versus non-cyclical stock, you can see that basically it means when the economy goes down, these stocks tend to go down with it. And when the economy booms, these tend to boom alongside it. Now notice that if we look here, even if you look on an annual basis, you can see how choppy it looks. Look at these big roars up and down. Now let me give you an example of a company that's a non-cyclical stock, one that's very consistent, very long-term growing, a long-term compounder. You see, other than its one hiccup here, it's generally growing over time. This is Procter & Gamble. What about one of my favorites? Not only as an investor, but also as a consumer as well. There's literally a Mountain Dew right next to me. Pepsi is one that is a long-term compounder. Sure, there's some times when we have little downturns like here in 2015, but generally speaking, I'll have you be the judge of where is this stock chart going over time? Where is this revenue chart going over time? And Pepsi is one of the most consistent growers out there. It doesn't matter if we're looking, look at this. Let me actually rewind here. Take a look at this. You can see the 2-year chart up and to the right, the 5-year chart up and to the right, the 10-year chart up and to the right, and the all-time chart. Well, you get the picture. It's up 11,500% up and to the right. Look how incredibly consistent a company like Pepsi is, and this is very unique to find a company this defensive. Those are the type of companies I want to be an owner of. A company that is going to be resilient despite the economic cycle. And this is the big problem that we typically face, is that speaking of economic cycles, I want you to ask yourself, What stage are we in right now? Well, if you look at these 4 stages, split between early expansion, middle expansion, late expansion, and recession, we're probably right around this bottom area, around where my mouse is at. We're around this region, somewhere between the words healthcare and materials. We're in the late end of the expansion going into a recession time. And what typically booms during a late recession? Materials, energy. These are the type of companies we just saw boom, and they're starting to come off now, and this follows the cycle perfectly. Now, what typically booms after that? You see consumer staples, telecom, utilities, healthcare. These are the companies that are going to benefit in the early run, and then until we lead into the early expansion, that's when we see growth again. Now, notice the funny part here is that if you look at all these, there's only one sector here that is shown twice. The 2 laptops, which is technology, in both the early and middle expansion, which notice that is heavy in my portfolio. Of the 4 companies that I invest in, 3 of them are big tech stocks. You can see there's Salesforce, Amazon, Google, and Crocs. Other than 23% that is in a spec play, which has actually been one of my best performers. Let me rephrase that. No, it is my best performer of the year. We're currently up about 30% year to date on Crocs in my investment. I bought it at 76. Today it's at around $100 a share or so. That has been a wonderful performer. But other than this one name that's been very successful, you see that most of my companies are big tech. Companies that have gone down in price, that are high growing technology companies that produce billions in free cash flow. So what I'm preparing for is as we go through this recession, as we go through this dark kind of light reddish salmon-y color right here, when we get into the dark green, the early expansion, and we get to the gray to light blue, the middle expansion, these 2 regions are what I'm preparing for. This might show up next month, it might show up 6 months from now, it might show up 2 years from now, but when it happens, I'm prepared because I have lots of stocks that are going to benefit from these types of expansions. And you see in the stock prices, typically as economies expand, you see stock prices expand. And as economy slows down, stock prices slow down. And this is perfectly how a company like Caterpillar has played out. Look in the most recent earnings and you can see that revenue is at one of the highest points it's been in years. What about profitability? At pretty much the highest point it's been in many years. What has the stock price done? Well, you guessed it, it's at one of the highest points in years. It's nearly at its all-time high as the company has paid out dividends and bought back its own shares. It is finally hitting a level that is a multiple higher than what you would typically see during a company of this economic cycle. I think that this revenue, you see the waves, you see how it goes up and then it goes down, up and down, and now it's at a peak. I think it's likely to start going down soon. And something that I want to see from companies during this time period is something like we just talked about in my last video. Go watch it if you didn't already. It was over my #1 position, Salesforce. This is a quote from the exact earnings release that they just had, 7 days ago from the time you're watching this video. So literally 1 week ago. He was talking about the recession and he said, quote, "We wrote it all down. We talked about what was happening. We knew what happened again. And we had to desk off some of the plans from the numbers 12, 13, and 22 years ago, talking about the last 2 recessions and the dot-com bubble and the Great Recession. And we've turned that playbook into gaining market share, focusing on operational discipline, operational excellence, and especially in the face of economic headwinds. Gaining market share, being operationally disciplined, having operational excellence. Focusing on profitability is something that Salesforce is currently doing, and this is an opportune time for them to gain market share while things are going down. If you look at Caterpillar, the earnings and the revenue is not nearly as consistent as a high-growth revenue company like Salesforce, who hits sequential revenue record quarter after quarter. Same thing for a long-term compounder like Pepsi. If you look on an annual basis for the long term, it's as consistent gets. And what you're seeing right here is a hypothetical investment going into Caterpillar over the last 20 years or so. This is if you put $100,000 in the stock right at the beginning of 2005, and you can see that it's had its up and downs and it's performed quite well. The compounded annual growth rate is 12%, which is not bad at all. 12% on a long-term basis. I'll take that any day, and I think many of you watching would. And in this scenario, your 12% compounded rate on a $100,000 investment over the next 20 years would grow to $770,000. Quite nice, 7.7x your money. However, when you compare this to high-growing tech companies, it is not even close. And you might be looking at this chart and saying, oh, it's not that far away. Is it really that big of a difference? Well, this is a logarithmic scale. Let's take off logarithmic. See the difference? This is not even close. You see the little bitty red line down below? That's Caterpillar compared against my number 1 and number 2 positions. We have the top 3 here. If you look at my holdings, number 1 Salesforce, number 2 is Amazon, and you can see that based on where we're at today on this 2005 investment, that $770,000 into Salesforce and Amazon would have become around $4 million. It would have been around 5x or so, actually about 5 to 6x the amount of performance that you would have seen from Caterpillar. Caterpillar compounded at 12% since 2005. These two have compounded around 22-23% since 2005. That is because they're investing in themselves. They have money during economic downturns to invest in their market share to gain a bigger piece of the pie. And then when the economy does move again, guess who's sitting pretty? So this is why I potentially could be selling out of Caterpillar. Stay tuned. I'm actually planning on making a lot of changes here in December, which I'll probably be implementing over the next week or two. But other than that, guys, thank you so much for watching. Sign up for MooMoo down below. Thank them for sponsoring this video. Other than that, guys, thank you so much for watching, and I'll catch you guys next time.